Silver is trading in the high 80s globally. It keeps testing the 90 level, it pulls back, it rallies again, it refuses to break. That's what retail traders see. Here's what they don't see. Shanghai reopened after Chinese New Year, and silver wasn't trading at 88. It opened above 100. Not a small premium. A double-digit gap between East and West for the exact same metal. And markets do not tolerate that kind of divergence unless something structural is happening underneath. Either China is irrational or the global spot price is wrong. But that's not even the real story, because while this pricing gap was widening, Chinese state media made a claim that stopped me cold. They accused the United States of planning to intervene in Mexico, not for drugs, not for immigration, but for silver. Specifically, for control of hundreds of billions in Mexican silver reserves. Pause. When a state-controlled media machine publicly frames a mineral as a military objective, that is not random commentary. That is strategic signaling. And the same country making that accusation is paying 14% more than the world price to secure physical silver. That's not coincidence. That's urgency. And once you see the supply data, the urgency becomes obvious. Mexico produces over 200 million ounces of silver per year. That is roughly 1/4 of global mine supply. China produces about 109 million ounces. Together, the two largest producers account for more than 300 million ounces annually, over a third of global output. Now look at the conditions in both countries. China has reclassified silver as a strategic material. Export licenses tightened, domestic retention prioritized, solar manufacturing accelerating, electronics demand surging, military applications expanding. Silver is no longer just an industrial input, it is infrastructure fuel. Now look at Mexico. Zacatecas, Durango, Chihuahua, core silver-producing states, all experiencing escalating cartel violence and operational instability, transport routes disrupted, workers intimidated, security costs rising, international firms reassessing exposure. Even modest production disruption in Mexico doesn't tighten the market, it detonates the deficit. Because last year, the silver market already ran a structural shortfall of roughly 67 million ounces. That deficit assumed Mexico operating normally. Remove even 15% of Mexican supply, and the shortfall doesn't rise gradually, it explodes. And this is happening while China is paying double digits. You don't pay 100 for silver if you believe supply is stable. You pay that when you believe supply is at risk. But supply risk is only half the story. Capital flows are the other half, and that's where this becomes dangerous.
There are reports circulating that major Chinese financial players are preparing to reallocate capital towards physical silver. Forget the headline noise. Focus on mechanics. If large Chinese institutions begin selling U.S. treasuries or equities to fund physical silver accumulation, three markets move at once. Treasuries fall, yields rise, U.S. borrowing costs increase, stocks face selling pressure, silver faces buying pressure. One transaction, three impacts. The U.S. is already running multi-trillion-dollar deficits. Higher yields mean higher interest payments. Higher interest payments compound debt. Now think about scale. The entire above-ground investable silver stock is tiny compared to global capital pools. It does not take trillions to destabilize silver. It takes imbalance. Even tens of billions in sustained buying would strain liquidity. Hundreds of billions would force repricing. And if sovereign capital enters, There is no model for that, because silver is not built to absorb sovereign-scale flows. And yet, Shanghai is already signaling sovereign urgency. That is not retail speculation, that is state-level positioning, which forces us to ask the bigger question: why silver? Why now? Gold weakens currencies, silver builds systems. Solar panels require silver, electronics require silver, semiconductors require silver, military systems require silver. China dominates solar manufacturing. China is scaling electronics production. China is expanding defense technology. Silver is not optional. Now imagine supply tightens sharply. Who suffers first? The largest industrial consumer, which is China. So tightening silver supply becomes leverage, not through missiles, through scarcity. Now bring Mexico back into the picture. If Mexican production falters meaningfully, if U.S. rhetoric escalates, if instability spreads, if capital flows shift simultaneously, silver becomes the pressure point between two superpowers. And pressure points don't trade like commodities. They trade like oil in 1973. They trade like rare earths during export bans. They trade based on national security, not charts, which is why 90 is irrelevant. Resistance levels don't account for geopolitical repricing.
Last year's global silver deficit was roughly 67 million ounces. That means the world consumed 67 million ounces more than it mined. That gap was filled by pulling metal from vaults. Vault inventories are not infinite. Now stress the model. If Mexico loses 30 million ounces of output due to instability, if China absorbs an additional 20 to 40 million ounces aggressively, if Western inventories continue draining, the deficit doesn't stay 67 million, it pushes toward 100 plus. And silver is not oil. There is no spare capacity cartel. There is no emergency stockpile large enough to stabilize pricing for long. At some point, price must ration demand. And when rationing begins, it accelerates, because industrial users panic. And panic buying in a small commodity market causes vertical repricing. Shanghai at 100 is not speculative frenzy. It may be early rationing. Let's run this cleanly. Scenario 1, de-escalation. Mexico stabilizes. Chinese demand moderates. Capital reallocation slows. Silver still moves higher due to structural deficit. Scenario 2, moderate escalation. Mexico output drops 10 to 20%. Chinese institutions accelerate accumulation. Western vaults continue draining. Triple-digit pricing becomes normal. Scenario 3, strategic escalation. Mexican supply disruption deepens. China deploys significant capital into physical silver. Treasury yields rise under selling pressure. Industrial users scramble for supply. Silver reprices aggressively, not gradually, aggressively, because once industrial consumers fear running out, they stop negotiating price. They secure inventory, and price becomes secondary. This is not hype. It is how commodity shortages behave.
6 months ago, silver was an undervalued trade. Today, it is increasingly a strategic asset caught between two economic powers. When state media accuses invasion over a mineral, when the largest producer faces instability, when the largest consumer pays extreme premiums, when deficits already exist, you are not looking at a normal market. You are watching pressure accumulate. Markets do not absorb pressure forever. They release it through price. The Shanghai premium is not random. It is a signal. Either it collapses or global spot rises to meet it. But divergence this wide rarely resolves quietly. And if sovereign capital, supply disruption and industrial panic converge at the same time, the repricing will not be subtle. It will be decisive. Silver is no longer just a metal. It is leverage. And leverage, when pulled by superpowers, moves markets fast.